In the vibrant landscape of Silicon Valley's ambition, a company named WeWork soared to unimaginable heights. Valued at an astounding $47 billion, it captivated investors and innovators alike, promising to revolutionize the very fabric of work. Yet, behind the gleaming glass of its co-working spaces and the intoxicating rhetoric of its founder, a more traditional business model hummed beneath the surface. This was not a story of disruptive technology, but a saga of real estate dressed in a tech costume, a grand illusion that would shatter within weeks, leaving behind a trail of billions lost and a powerful lesson in financial reality. At the heart of WeWork's meteoric rise was Adam Neumann, a figure whose towering charisma and boundless enthusiasm were as central to the company's identity as its shared office spaces. Born in Israel, Neumann envisioned more than just desks and Wi-Fi. He promised a global community, a lifestyle brand, and a revolution in how people worked and lived. His magnetic personality drew people in, creating a fervent belief in a future where WeWork was not merely an office provider, but a profound cultural movement, shaping cities and human connections. WeWork began humbly in 2010, founded by Adam Neumann and Miguel McKelvey. Their initial concept was straightforward: lease large office spaces, renovate them with appealing designs and amenities, and then sublease them to individuals and companies on flexible terms. This model wasn't new, serviced offices had existed for decades. But Neumann infused it with an irresistible narrative, marketing WeWork as a solution for modern, collaborative work, a place where innovation thrived through shared experience. It was about community, culture, and connection, a stark contrast to the sterile corporate environments of the past. Crucially, Neumann didn't merely present WeWork as a real estate venture. He meticulously crafted a narrative that positioned it as a groundbreaking technology company. The argument was simple: WeWork wasn't just leasing space, it was leveraging data, building a proprietary operating system for physical space, and creating a global network effect. It claimed its technology optimized office layouts, predicted demand, and fostered community engagement. This tech-centric branding allowed WeWork to escape the relatively lower valuations typically assigned to real estate companies and instead seek the sky-high multiples reserved for disruptive tech giants. Adam Neumann was a master storyteller. He spoke not of square footage and lease agreements, but of elevating the world's consciousness, of community, of bringing people together. He painted a picture of WeWork as a movement, not just a business, a place where members found meaning and belonging. This potent blend of mission-driven rhetoric and a seemingly innovative tech layer proved irresistible to investors eager to find the next big disruptor. Neumann's ability to sell this grand vision was arguably his most significant asset, overshadowing the underlying financial mechanics of the company. Enter SoftBank, the Japanese conglomerate led by its enigmatic founder, Masayoshi Son. Son had a singular ambition: to invest in world-changing technology companies through his gargantuan Vision Fund. This fund, backed by Saudi Arabian and Abu Dhabi sovereign wealth funds, sought out audacious founders with grand visions, pouring billions into companies like Uber, DoorDash, and eventually, WeWork. SoftBank's strategy was to accelerate growth at an unprecedented pace, believing that market dominance, even at the expense of early profitability, would ultimately yield massive returns. SoftBank's investment in WeWork was nothing short of monumental. Between 2017 and 2019, SoftBank and its Vision Fund poured over $10 billion into the company. This massive capital injection fueled WeWork's aggressive global expansion, allowing it to lease more buildings, hire more staff, and acquire various ancillary businesses. The influx of cash, combined with Adam Neumann's infectious optimism, created an intoxicating environment where growth was prioritized above all else. Profitability was a concern for a distant future. The immediate goal was market saturation and becoming the undisputed leader in space as a service. With SoftBank's backing and Neumann's charismatic leadership, WeWork's valuation soared to stratospheric levels. By early 2019, private investors, swayed by the tech narrative and the sheer scale of SoftBank's commitment, valued the company at an astonishing $47 billion. This placed WeWork among the most valuable startups globally, seemingly justifying its ambitious claims and Adam Neumann's vision. The valuation was not based on traditional metrics like consistent profits or a clear path to them, but on the promise of future dominance and the captivating story being told. The immense wealth and rapid growth fostered a culture of excess within WeWork, particularly at the top. Adam Neumann's lifestyle became increasingly lavish, reflecting the company's unrestrained spending. Private jets, extravagant parties, and a penchant for unconventional business decisions became hallmarks of his leadership. This high-flying, visionary approach seemed, for a time, to be a symptom of success. Investors, blinded by the perceived potential, often overlooked these warning signs, attributing them to the eccentricities of a groundbreaking founder rather than systemic governance issues. Beneath the surface of celebratory headlines, serious governance issues began to emerge. Adam Neumann held absolute control over WeWork through a super-voting share structure, effectively rendering the board of directors powerless to challenge his decisions. This concentration of power, combined with several glaring conflicts of interest, raised significant red flags for those paying closer attention. Neumann personally owned properties that he then leased back to WeWork, profiting directly from the company's expansion. He also famously trademarked the word "we" and then sold it back to WeWork for millions. The moment of truth arrived in August 2019, when WeWork formally filed its S-1 prospectus for an initial public offering. This document, intended to provide transparency to potential public investors, instead became a shocking exposé of the company's true financial state and governance practices. What had been overlooked by private investors, mesmerized by Neumann's narrative and SoftBank's deep pockets, was now laid bare for the entire world to scrutinize. The S-1 filing quickly became a public spectacle, revealing a company hemorrhaging money with questionable leadership. One of the most infamous revelations in the S-1 was WeWork's use of unconventional financial metrics, most notably community-adjusted EBITDA. This bespoke measure excluded a host of expenses, including marketing, general and administrative costs, and even basic depreciation, attempting to present a more favorable, but ultimately misleading, picture of profitability. Financial analysts and experienced investors quickly ridiculed this metric, highlighting the desperate attempt to obscure substantial losses and paint a real estate company as a high-margin tech enterprise. It was a glaring red flag that could not be ignored. Beyond the creative accounting, the S-1 revealed the stark reality of WeWork's financials: massive, escalating losses. In the first half of 2019 alone, the company lost over $900 million. This wasn't a temporary dip, it was a fundamental aspect of its rapid expansion strategy. For every dollar of revenue WeWork generated, it was spending significantly more, primarily on leasing new buildings, fitting them out, and attracting members with expensive incentives. The dream of tech-like margins vanished, replaced by the grim reality of a capital-intensive real estate business that had no clear path to profitability. The detailed scrutiny of the S-1 filing quickly eroded investor confidence. What had seemed like minor quirks or the price of visionary leadership in the private market now appeared as severe liabilities in the public sphere. Institutional investors and seasoned analysts, who conduct far deeper due diligence than many private VC funds, began to question every aspect: the unsustainable growth model, the exorbitant executive spending, and Adam Neumann's unchecked power. The narrative of a tech company, once so compelling, began to unravel under the weight of financial fundamentals. The fundamental problem was exposed: WeWork was essentially a master tenant. It took on long-term lease liabilities, often for 10 to 15 years, and then attempted to make a profit by subleasing those spaces on short-term, flexible agreements. This model worked well in a booming economy, but left the company highly vulnerable to economic downturns and fluctuating demand. Competitors like IWG, formerly Regus, which operated a similar model, were valued at a fraction of WeWork's asking price because they were seen for what they were: real estate companies, not tech innovators with limitless upside. The valuation discrepancy became glaringly obvious. Tech companies command high multiples based on scalability, intellectual property, and often low capital expenditure once built. Real estate companies, conversely, are valued on tangible assets, predictable cash flows, and are inherently capital intensive. WeWork's core business, despite its marketing, was the latter. The market finally saw through the tech facade, recognizing that WeWork's operations mirrored traditional landlords, not Silicon Valley unicorns. The $47 billion valuation, based on tech multiples, was entirely out of step with its underlying business reality. As the IPO approached, Adam Neumann's personal behavior and controversial decisions came under intense scrutiny. Stories emerged of him flying private jets, sometimes transporting marijuana across international borders, and having a rather erratic management style. His decision to sell his personal We trademark to the company for $5.9 million, only to return it after public outcry, became a symbol of his questionable ethics and self-dealing. These anecdotes, once dismissed as founder quirks, now fueled serious concerns about corporate governance and leadership maturity, further souring public sentiment. The mounting pressure from investors and the public became unbearable. With institutional investors refusing to buy into the proposed valuation and a growing chorus of skepticism, WeWork had no choice but to postpone its IPO in mid-September 2019. This was a direct admission that the market did not accept the company's valuation or its business model as presented. The once unstoppable momentum of Adam Neumann's vision had been decisively halted. The dream of a public offering, once within reach, now seemed a distant and uncertain prospect. For SoftBank, WeWork's unraveling presented a massive crisis. Having poured billions into the company and pushed for its aggressive growth and sky-high valuation, SoftBank's reputation and the credibility of its vision fund were on the line. Masayoshi Son, who had championed Neumann, now faced the prospect of a colossal write-down. The initial $47 billion valuation SoftBank had helped engineer was now widely seen as a fantasy, forcing Son to make difficult decisions to salvage his investment and protect his fund's standing. As the IPO failure loomed and the company teetered on the brink of financial collapse, pressure mounted on Adam Neumann from all sides. Major investors, including SoftBank, demanded a change in leadership. Less than 2 weeks after the IPO was postponed, on September 24, 2019, Adam Neumann was forced to step down as CEO of WeWork. It was a swift and dramatic fall from grace for the charismatic founder who had embodied the company's entire identity. His departure marked the definitive end of an era of unrestrained vision and unchecked power. Following Neumann's ouster, WeWork was in a desperate financial state, facing an imminent cash crunch. SoftBank, the company's largest investor, stepped in with a massive bailout package totaling over $9.5 billion. This complex deal involved a new debt facility, accelerated equity investments, and a tender offer to buy out existing shareholders, including Neumann himself. For SoftBank, it was a costly rescue mission, an attempt to stabilize its ailing investment and prevent a complete collapse that would have been a catastrophic blow to the Vision Fund's prestige and financial standing. The $47 billion valuation, once a symbol of audacious ambition, evaporated almost overnight. In the wake of the failed IPO and Neumann's departure, WeWork's valuation plummeted by more than 80%. SoftBank's bailout valued the company at a mere $8 billion, a stunning reduction. This dramatic freefall demonstrated the harsh reality of public market scrutiny and the unforgiving nature of financial fundamentals. The tech valuation bubble had definitively burst, revealing a conventional real estate business that was deeply unprofitable and structurally flawed. With Adam Neumann gone, WeWork embarked on a painful process of restructuring and cost-cutting. Thousands of employees were laid off, non-core businesses were divested, and the company pulled back from its aggressive global expansion. The new leadership focused on fundamental business principles, achieving profitability, streamlining operations, and reducing its massive lease liabilities. It was a stark pivot from the growth at all costs mentality that had defined the Neumann era, a slow and difficult journey to transform a perceived tech unicorn into a sustainable, if less glamorous, real estate operator. The collapse of WeWork stands as a potent cautionary tale for the startup world and the broader financial markets. It exposed the dangers of unchecked founder power, the allure of a compelling narrative over sound financials, and the risks of excessive capital chasing unsustainable growth. The story is a stark reminder that even the most charismatic leaders and the most ambitious visions cannot defy gravity indefinitely when fundamental business principles are ignored. Ultimately, real financial performance, not just perceived technological disruption, determines long-term value. The core lesson from WeWork's spectacular implosion is clear: financial fundamentals unequivocally matter. While innovation, vision, and a strong narrative can attract initial investment and propel growth, they cannot sustain a business that consistently operates at a loss, lacks clear governance, and fundamentally misrepresents its core offering. The market, eventually, will distinguish between genuine technological disruption and clever rebranding. WeWork's journey from $47 billion darling to a struggling entity is a testament to the enduring power of sound financial management and realistic valuation principles. SoftBank's Vision Fund, once lauded for its audacious bets, faced intense scrutiny after the WeWork debacle. The immense losses from WeWork, coupled with other underperforming investments, forced SoftBank to adjust its strategy and become more cautious. It revealed the potential pitfalls of pouring vast sums into companies without rigorous due diligence on profitability and governance. The WeWork story became a prominent example of how even a behemoth like SoftBank could be swayed by charismatic founders and compelling narratives, leading to profoundly expensive missteps. The WeWork collapse serves as a crucial reminder that not every innovative idea is a tech company, and not every ambitious founder is building the next Amazon. The tech label was a powerful tool, allowing WeWork to access capital at valuations far exceeding its actual business model. However, the hype cycle eventually ends, and companies are left to face the harsh realities of their balance sheets and income statements. This story underscores the importance of critical thinking and robust due diligence, especially when valuations seem detached from tangible assets and traditional profitability metrics. Adam Neumann's journey from visionary leader to disgraced founder is a complex one. While his ability to inspire and build a global brand was undeniable, his ultimate downfall was rooted in a disregard for sound business practices, a lack of accountability, and a failure to translate his grand vision into a sustainable, profitable enterprise. His story is a powerful illustration of the double-edged sword of charisma. It can attract immense opportunities, but without grounding in reality, it can also lead to spectacular failure. The line between genius and delusion proved to be razor-thin for Neumann. Despite its dramatic collapse and financial woes, WeWork continues to operate, albeit as a vastly different company. It has shed much of its former identity, focusing on its core business with a renewed emphasis on fiscal responsibility. The enduring legacy of WeWork is not just its story of a bubble bursting, but also its contribution to changing the conversation around flexible workspaces. It normalized co-working and influenced office design, proving that there's a real demand for adaptable, community-focused environments. The idea was powerful, the execution, particularly the financial and governance aspects, was deeply flawed. The WeWork saga serves as a timeless reminder that market exuberance can often blind investors to fundamental flaws. In every economic cycle, new narratives emerge, promising unprecedented disruption and justifying sky-high valuations. But beneath the surface, the immutable laws of economics and sound business principles always prevail. The question is not if another such bubble will form, but when, and which charismatic leader will next convince the world that their real estate company, or delivery service, or social media platform, is truly a revolutionary tech giant worthy of seemingly infinite capital. Long before WeWork, the concept of shared office spaces existed, but WeWork propelled it into the mainstream. They were exceptional at branding, creating appealing spaces, and fostering a unique sense of community. Their success wasn't just about renting desks, it was about selling an experience, a lifestyle that resonated with startups, freelancers, and even large corporations seeking flexibility. This shift in how office space was perceived and consumed was a genuine innovation, albeit one fundamentally rooted in the physical world of real estate, not the digital realm of pure technology. Adam Neumann's ambition extended beyond WeWork itself. He envisioned a sprawling ecosystem, dubbed the We Company, which included WeLive for co-living, WeGrow for a private school, and even a Surfwave pool venture. These expansions were meant to demonstrate the limitless potential of the We brand, a holistic approach to living, working, and learning. However, these ventures further diluted the company's focus, diverted capital, and solidified the impression of an overly ambitious, unfocused empire that lacked a clear, profitable core business beyond its primary real estate operations. WeWork's claim to be a tech company often revolved around its proprietary software and data analytics. It asserted that its technology could optimize space utilization, manage community engagement, and provide insights into member behavior. While WeWork undoubtedly used technology, as nearly all modern businesses do, it was largely in support of its core real estate operations. The tech was an enabler, not the product itself. The market eventually recognized that a company using software to manage office leases is still fundamentally a real estate company, not a software giant. Masayoshi Son's personal conviction in Adam Neumann's vision played a crucial role in SoftBank's massive investment. Son was captivated by Neumann's grand narrative of changing the world and believed WeWork had the potential to be a trillion-dollar company. This strong belief in founders and their ambitious visions was a hallmark of the Vision Fund's strategy. However, this conviction, at times, seemed to override traditional financial analysis and risk assessment, leading to situations where growth was prioritized over profitability to an extreme degree, with WeWork being the most prominent example. The WeWork story also highlights a broader trend in venture capital, the chase for unicorns, startups valued at over $1 billion. This model often incentivizes rapid and profitable growth in hopes of achieving market dominance and a lucrative exit. For a long time, the private markets were willing to overlook red flags, fueled by FOMO, the fear of missing out on the next big thing. WeWork pushed this model to its absolute limit, demonstrating how an abundance of capital, coupled with a compelling story, can create valuations entirely detached from reality. The governance issues at WeWork were not merely a side note, they were central to its vulnerability. A board of directors should provide checks and balances, but Neumann's super-voting shares effectively neutralized any dissent. This allowed him to make self-serving decisions, like trademarking and leasing his own properties to the company, without effective oversight. Such arrangements, while sometimes present in early-stage startups, become critically problematic when a company is seeking public investment and is valued in the tens of billions. Strong, independent governance is a cornerstone of investor trust. The S1 document became a mirror reflecting WeWork's true image, far removed from the polished narrative. It didn't just expose financial losses, it detailed the specific mechanisms of Adam Neumann's control, his personal loans from the company, and the tangled web of related party transactions. This unfiltered view forced public market investors to confront the reality that WeWork was less a lean, efficient tech disruptor and more a sprawling, financially convoluted enterprise deeply intertwined with its founders' personal interests. It was a wake-up call that charisma alone cannot dictate public market terms. WeWork's business model was inherently cash-intensive. Leasing prime real estate in major global cities, undertaking extensive renovations, and then operating these spaces required vast sums of capital upfront. The company was essentially a giant construction and interior design firm, alongside being a landlord. While it generated revenue, its operating expenses consistently outstripped it, leading to a relentless burn rate. This meant it was constantly in need of more funding, creating a precarious dependency on external investors, a dependency that became fatal when the IPO market closed its doors. The market's rejection of WeWork's IPO was not just about the specific company, it was a broader signal. It demonstrated a shift in investor sentiment, a growing weariness with unprofitable growth at all costs strategies, particularly for companies that couldn't credibly claim a unique technological moat. Investors were increasingly demanding a clear path to profitability and sustainable business models, rather than simply betting on a compelling story and a charismatic founder. The WeWork incident became a turning point, ushering in an era of greater scrutiny for late-stage private companies seeking public funds. Beyond the billions lost and the corporate drama, the WeWork collapse had a profound human cost. Thousands of employees, many of whom had bought into Adam Neumann's vision and the company's culture, faced layoffs and uncertainty. The dreams of stock options turning into wealth evaporated. The rapid growth had fostered a sense of belonging and excitement, only to be replaced by disillusionment and job insecurity. This human element underscores that business decisions, especially those driven by inflated valuations and unsustainable practices, have very real and often devastating consequences for individuals. For WeWork, the journey forward involves not just financial restructuring but also rebuilding trust. Trust with employees, with landlords, and with any future investors. This means embracing transparent governance, making financially prudent decisions, and demonstrating a commitment to a sustainable business model. The company's rebranding from the We Company back to simply WeWork was a symbolic step, signaling a return to its core business and a departure from the boundless, but unfocused, ambitions of the Neumann era. It's a long road back from such a public and spectacular fall. Even after his dramatic exit, Adam Neumann's story continues to evolve. His ability to attract capital, despite the WeWork collapse, demonstrates the enduring power of his charisma and network. He has since re-emerged with new ventures, again attracting significant investment, proving that some investors remain willing to bet on the individual rather than solely on established track records. This highlights a persistent human element in finance, the desire to believe in a compelling vision, even when past results suggest caution. It underscores the perpetual tension between human belief and cold, hard numbers. The tale of WeWork's $47 billion collapse is one for the business history books. It encapsulates the peak of a particular era of venture capital excess, characterized by a willingness to suspend disbelief in the pursuit of exponential growth. It serves as a vivid illustration of the delicate balance between innovation and sustainability, ambition and accountability. As financial markets continue to evolve, the WeWork story will undoubtedly remain a touchstone, a powerful narrative reminding future generations of investors and entrepreneurs that the allure of a compelling story must always be anchored by the immutable laws of financial reality. After Adam Neumann's departure, WeWork installed new leadership, aiming for a more conventional and financially disciplined approach. The new executives focused on rationalizing the company's real estate portfolio, negotiating with landlords for better terms, and exiting in profitable locations. The emphasis shifted dramatically from breakneck expansion to operational efficiency and achieving positive cash flow. While no longer the high-flying tech darling, this refocused WeWork sought to prove that its underlying co-working business could indeed be viable, just not at the unrealistic valuations previously projected. SoftBank, as WeWork's largest investor, faced immense pressure to justify its investment strategy. The company reported significant quarterly losses, primarily due to the devaluation of its WeWork stake and other Vision Fund holdings. This forced Masayoshi Son to publicly acknowledge the mistakes made, particularly in overvaluing WeWork. The write-down served as a humbling moment for the investment giant, prompting a re-evaluation of its go big or go home approach and a renewed focus on profitability for its portfolio companies, even those with grand visions. Eventually, WeWork did manage to go public, but not through a traditional IPO. In October 2021, nearly 2 years after its initial failed attempt, WeWork went public via a SPAC merger, valuing the company at approximately $9 billion. While a significant achievement, it was a far cry from the $47 billion valuation once envisioned. This public debut, while successful in its own right, served as a stark reminder of the painful journey of recalibration, the hard lessons learned, and the fundamental differences between private market hype and public market reality. It was a quieter, humbler debut. The WeWork story remains a powerful testament to the influence of narrative in business. Adam Neumann's ability to weave a compelling story about community, technology, and a global movement was instrumental in attracting billions in capital. He didn't just sell office space, he sold a dream. This highlights how human emotions, particularly hope and aspiration, can often override rational financial analysis, especially in speculative markets. The challenge for investors is to always look beyond the captivating story and delve into the tangible, verifiable business model and its financial underpinnings. Ultimately, the central question for WeWork, and for many startups employing similar tactics, was whether it was a genuine disruptor or simply a clever reimagining of an existing industry. While WeWork undoubtedly innovated in terms of design, branding, and user experience, its core operation remained that of a glorified landlord. The distinction is crucial for valuation. Genuine tech disruption often leads to scalable, high-margin software businesses, while physical real estate is burdened by capital intensity, long-term liabilities, and cyclical market forces. The market finally enforced this fundamental distinction. The WeWork bubble burst within 6 weeks of its IPO filing, a remarkably swift and brutal correction. From a private valuation of $47 billion in August 2019 to a proposed IPO valuation dramatically lower than its postponement, and finally, a bailout valuation of $8 billion, the speed of its demise was astounding. This rapid deflation served as a stark warning about the fragility of valuations built on hype rather than hardy financial foundations. It demonstrated that even the largest, most seemingly unstoppable private companies are not immune to the cold logic of public market scrutiny once exposed. Adam Neumann's story is also a lesson in the dangers of excessive CEO power, particularly when combined with an inability or unwillingness to listen to dissenting voices. His supervoting shares effectively insulated him from accountability, allowing him to pursue his vision without significant checks. This concentrated power contributed directly to the governance failures, conflicts of interest, and ultimately, the financial mismanagement that led to WeWork's near collapse. It underscores the critical importance of a balanced power structure, independent board oversight, and clear lines of accountability in any public, or aspiring public, company. WeWork's journey highlights a key difference between private and public markets. Private investors, especially venture capitalists, are often more willing to take larger risks, bet on potential, and accept unprofitable growth in the hope of exponential returns. Public markets, however, demand transparency, profitability, and sound governance. The transition from private to public acts as a crucial filter, often exposing the vulnerabilities that were overlooked in the excitement of private investment rounds. WeWork simply couldn't withstand this filter when its moment came. For WeWork, the path forward remains challenging but clearer. It's about building a sustainable business, not just a captivating narrative. This involves disciplined growth, efficient operations, and a focus on delivering value to its members while managing its significant real estate liabilities. The company's story now serves as a blueprint for how not to scale a business, and a guide for how to pivot back to core principles. It's a marathon, not a sprint, a lesson learned through billions of dollars and a spectacular fall from grace. Beyond the sensational headlines and the dramatic figures, the WeWork collapse underscores a fundamental truth about business. Ultimately, value is created not by hype, but by solving real problems profitably and sustainably. While innovation and vision are vital, they must be grounded in realistic financial models and responsible leadership. The $47 billion collapse of WeWork is more than just a cautionary tale, it's an enduring case study in how the allure of a charismatic founder and a compelling story can, for a time, overshadow the undeniable power of financial fundamentals. The fallout from WeWork's collapse rippled through the investment community, forcing a re-evaluation of valuation methodologies for pre-IPO companies. Investors became more cautious about blindly accepting tech labels for businesses with heavy asset bases. This led to a more discerning approach, demanding clearer paths to profitability, robust governance, and a better understanding of underlying business models. The WeWork saga, alongside other high-profile stumbles, contributed to a tightening of the venture capital spigot and a more sober assessment of startup potential. It's important to remember that WeWork operated within the highly cyclical and often unforgiving real estate market. The company thrived during a period of economic expansion and low interest rates, which fueled demand for office space. However, its model of long-term leases and short-term subleases left it acutely vulnerable to market downturns. The economic realities of real estate, with its inherent capital intensity and market fluctuations, were always at odds with the asset-light tech company narrative WeWork tried so hard to portray. The market eventually exposed this fundamental contradiction. Adam Neumann's personality was intrinsically linked to WeWork's brand and valuation. His boundless energy, unconventional ideas, and almost messianic self-belief were incredibly effective in attracting initial capital and talent. However, these same traits, unchecked by strong governance and financial discipline, became significant liabilities. The story clearly shows how the cult of personality around a founder can propel a company to great heights but also lead to its dramatic downfall if not balanced by sound business acumen and a strong, independent board. He was both its greatest asset and its greatest liability. The $47 billion valuation represented a profound disconnect between the perception of WeWork and its reality. It was a valuation that could only be justified if WeWork were truly a software company, commanding high multiples for intellectual property and subscription revenue with minimal operational costs. Instead, it was a company tied to physical assets, incurring massive lease obligations, and with a business model that required constant capital infusion. The public markets simply could not reconcile this fundamental disparity, leading to the rapid and painful re-evaluation. SoftBank's role in the WeWork saga remains a complex conundrum. While its aggressive investment fueled WeWork's unprecedented growth, it also arguably enabled Adam Neumann's excesses and the inflated valuation. SoftBank's vision fund model encouraged founders to pursue growth at all costs, often at the expense of profitability, believing that market dominance would eventually translate into astronomical returns. The WeWork experience forced SoftBank to confront the limits of this strategy and the need for more stringent financial oversight, even for the most promising and charismatic ventures. The WeWork story serves as a stark reminder of the paramount importance of thorough due diligence, not just for financial metrics but also for corporate governance and leadership. Private market investors might have been swayed by the vision, but public markets demanded verifiable facts and transparent operations. The eventual collapse highlights that while opportunity is important, an understanding of risk, a critical eye on financials, and a robust framework for accountability are indispensable. No amount of charisma can substitute for these fundamental safeguards. The implosion of WeWork had a significant chilling effect on the broader startup ecosystem. It made investors, particularly those in later funding rounds, more wary of companies that presented themselves as tech disruptors but lacked a strong technological core or a clear path to profitability. This resulted in increased pressure on startups to demonstrate sustainable business models, healthier unit economics, and responsible governance from an earlier stage. The era of blitz scaling without a credible plan for profit began to wane, replaced by a more cautious, data-driven investment climate. Ultimately, the $47 billion collapse of WeWork is an enduring lesson in the power and perils of narrative. Adam Neumann's vision transformed office space into a global movement, captivating investors and promising exponential returns. But beneath the veneer of technological disruption lay the tangible, capital-intensive reality of a real estate company. The bubble burst when the narrative could no longer obscure the financial fundamentals. Charisma and a compelling story can open doors, but only sustainable value creation, responsible governance, and a clear path to profitability can keep them open. Let's review WeWork's tumultuous financial journey in numbers. From a private valuation that reached a staggering $47 billion, to the revelation of over $900 million in losses in just half a year, and the subsequent drastic revaluation down to $8 billion following SoftBank's bailout, the numbers tell an unequivocal story. These figures underscore the incredible speed at which market perception can shift when exposed to the harsh light of financial transparency, and how quickly an inflated valuation can correct itself when real fundamentals are brought to bear. The collapse was a confluence of several critical factors, each amplifying the others. Firstly, the fundamental misclassification of a real estate company as a tech giant. Secondly, Adam Neumann's charismatic but controversial leadership, coupled with weak corporate governance. Thirdly, SoftBank's aggressive investment strategy that prioritized growth over profitability. And finally, the unforgiving scrutiny of public markets, unwilling to accept a valuation built on hype and unconventional metrics. This perfect storm created the conditions for one of the most spectacular startup implosions in recent memory. Adam Neumann's vision for WeWork was undeniably captivating and in many ways, transformative for the co-working industry. He identified a real need for flexible, community-focused workspaces and excelled at creating a strong brand identity. However, his vision became detrimental when it disconnected from financial reality and ethical governance. The ambition was grand, but the execution lacked the necessary discipline and accountability. This raises a critical question: at what point does a visionary's ambition cross the line into unsustainable delusion, especially when unchecked by external forces? The WeWork ordeal forced SoftBank and Masayoshi Son to confront significant challenges and rethink their investment philosophy. It highlighted the risks of concentrating too much power and capital in a single, high-growth, yet unprofitable, company. SoftBank has since emphasized greater financial discipline across its portfolio, pushing for profitability and more rigorous due diligence. The experience, while costly, became a catalyst for a more cautious and fundamental-driven approach, shaping the future trajectory of one of the world's largest technology investors. Despite WeWork's turbulent history, the demand for flexible workspaces continues to grow, particularly in a post-pandemic world. The shift towards hybrid work models has validated the underlying need that WeWork initially tapped into. This proves that the concept itself was robust. The lesson for the flexible workspace industry is clear: deliver on the promise of adaptability and community, but do so with sustainable business practices, prudent financial management, and realistic valuations. The future of work is indeed flexible, but its foundation must be firm. The WeWork story is the ultimate clash between a compelling narrative and an undeniable reality. Adam Neumann's charisma created a powerful story of a tech company transforming the world. SoftBank's capital amplified this story to a $47 billion valuation. But when subjected to the cold, hard facts of an IPO filing, the reality of a capital-intensive real estate business with massive losses and governance issues burst the bubble. This saga serves as a permanent testament: in the long run, fundamental financial truths will always prevail over even the most captivating and well-funded narratives.